Up next, we have a fireside chat. I have a fireside chat with Brian Daly from. He's the co-founder and CEO of Ground Floor. And Brian, are you with us?
I am. Can you hear me and see me?
Yes, I can hear you and I can see you. And I am in the process of just getting the video ready to play. While that finishes its download, I'm going to do my introduction. For those of you that don't know me, my name's Michael Corselli. I am the founder and chairman of Flya. And as I mentioned earlier, I am joined by Brian Daly, co-founder and CEO of Ground Floor. Um, Before we get started, I would like to encourage all the attendees today to use the Q&A function listed on the actual Zoom toolbar. We want this to be an interactive discussion. Today's conversation is going to be about democratization and what it really means and how it's played out in the past year. Brian's going to share his thesis behind Ground Floor and how the company has remained true to its mission. Um, you know, he's been in the trenches now for 8 years, doing this track record. It's a special company that he's been building, and he's going to go over some of the high level details and successes that him and the company have been able to achieve. It's very impressive. Brian has a very impressive personal background, which I'll allow him to share with you. And what Ground Floor has been able to achieve is very impressive as well. But there's a couple of little points that I want to bring up. First off, Brian knew at age 13 that he wanted to be a lawyer and he wanted to go to Harvard. Today, he has his JD and MBA from Harvard. And even though he was able to accomplish that, he is a serial entrepreneur. And you'll hear that in the story. You'll hear that in the innovation and the change that he's bringing to this capital market space and being able to bring that to the regular investor. So with that said, a couple of quick details before I turn it over to him. Ground Floor through Reg A was the first. It was the first company qualified by the Securities Exchange Commission to offer direct real estate-based debt investments for everyone, including accredited and non-accredited investors. Fast forward to today, this 8-year company has more than 87,000 registered users across the U.S. who have invested more than $270 million in 1,800 real estate notes. They've repaid more than 1,000 notes for over 140 million bucks, delivering investors a 10.6% average annualized return. In 2020, Ground Floor raised over $147 million. And as I mentioned before, their track record sits at 8 years. The average duration on a loan made through Ground Floor is 9 to 10 months. And with that, I'm going to turn this over to Brian so that he can give you a 10,000-foot view on Ground Floor and more detail on his background. And I'm going to try and work out the technology issues. Brian?
Sure thing. Can you guys see my video? Am I showing up there? Not the me talking on the recorded video, but me talking live?
Yes, you are.
Oh, good. I'm not seeing myself on there, so I wasn't sure. Michael said, from age 13, I knew that I wanted to, actually, I had two goals. I wanted to go to Harvard Law School and be a lawyer. But another goal was I wanted to be an NHL hockey player, a goalie specifically. Obviously, one of the goals I achieved, the other one not so much. But that was my dream. We started Ground Floor 8 years ago with a simple insight that I think matters to everybody here on this call. I mean, Wall Street and the banks when it comes to your investments. You know, we all worry. You look at the GameStop saga, you look at what happened during COVID-19. We all worry about, we as individual investors, whether we are getting our fair share of the pie. We started the company 8 years ago to do what we do because we realized that the problem isn't so much that we're not all getting our fair share of the pie. That may or may not be true. What's more insidious is we're not even being served the same thing. And so what I mean by that is that most of us, when we think about our investing, whether it's in your IRA or in a taxable account, whether you're trading or whether you're investing for the long term, most of us really deal in a world of public market securities or very highly restricted private market options. You just don't, you sort of have this false alternative as an investor that you have to take public market risk and you've got to play in what people feel might be sort of a rigged casino on one hand, or you've got to turn your money over to somebody who, you got to have a guy, you got to have an in. If you're an accredited investor, you have more opportunities to do that than if you're in one of the 95% of US households that's not accredited. We created the company to bring that same public market disclosure and confidence in a format that can't be gamed and can't be rigged by the banks and Wall Street. We wanted to bring that to private markets, because private markets is where we think a lot of the return is, a lot of the excess return at lower risk. And that's what we've been developing in the residential real estate market over the last, as a series of investment products over the last 8 years. So that's a little bit of a thumbnail sketch. Are you teeing up the video to tell people about it, or do you want to move on and just keep our conversation going?
Let's try the video. It seems to be working on my end. So let's give that a whirl.
What if you could invest in real estate yourself without hiring a broker, turning your money over to a fund, or coming up with thousands of dollars to get started? What if you could earn returns that were higher and more dependable than the stock market with less risk? What if you could be the bank for a change?
GROUNDFLOOR is on a mission for the average investor. We believe saving and investing really matters in the world.
Getting here required a historical regulatory milestone. GROUNDFLOOR is the first and only issuer of payment-dependent real estate notes ever qualified by the SEC. We're innovating within U.S. securities law to make investment products that are accessible to everyone.
And by everyone, we mean all of us. We think we all deserve a shot, not just the top 5%. So with just $10, anyone can get started investing with GROUNDFLOOR and earn the high risk-adjusted returns real estate can offer. Here's how it works. GROUNDFLOOR's real estate loans connect regular people who want to invest with those who want to borrow funds for real estate renovation projects happening all over the country. The loans are short-term and high yield, meaning you're able to put your money to work and earn returns on it quickly. Unlike on other platforms, GROUNDFLOOR investors choose which projects they want to invest in and how much to invest in each. And since we're nationwide, some of these projects may be right in your backyard, meaning that not only are you earning a return on your financial investment, but you are helping to fund the development of a community you care about. Once a project is completed and the house is sold on the market or refinanced, everyone who invested receives repayment for their part of the loan that financed it. Thousands of Americans have invested millions of dollars in GROUNDFLOOR's real estate loans, and results have been strong. We've originated hundreds of loans for real estate developers while simultaneously delivering double-digit returns to GROUNDFLOOR investors every year, 5 years in a row. The world is catching on. NPR's marketplace is called GROUNDFLOOR Innovative. The Washington Business Journal noted, now you can easily invest in a specific house flip without picking up a shovel. USA Today stated that GROUNDFLOOR has opened up real estate investing to the general population and that we have been embraced by developers. Join us on our mission to level the playing field in saving and investing. Invest in real estate through GROUNDFLOOR today. Signing up is easy. Just go to groundfloor.com to set up an account and get started.
All right, great. So it finally worked.
Awesome.
It finally worked. So, Brian, do you mind quickly going into, when GROUNDFLOOR launched and, what the thesis was behind it?
Building and protecting wealth.
Yeah, you're getting the next video though. There you go. Yeah, sure. So when we started, we had this I've been an individual investor since about age 15. I've always loved investing in stocks and mutual funds, and then index funds, and then ETFs when those came out. And I've always I've watched the rise of Robinhood with fascination, right? Harkening back to the early days of E-Trade. I've really sort of stayed close to this sector for a long time. And although I was working in the wireless industry, investment has always been a hobby for me. When I was thinking about what company I wanted to start next, after having started a wireless company called Republic Wireless, I noticed that coming out of the 2008, 2009 sort of Occupy Wall Street, movement, the feelings that people had about sort of the typical intermediaries on Wall Street, there was a lot of room to create a new investment product that would open up these private markets where Wall Street, hedge funds, banks have always kind of played, and individual investors could play if they're an accredited investor. We had the idea that we could create a new financial product to let people get into those markets in a digestible format, an efficient format, one that doesn't require you to, take $50,000 and put it to work in one opportunity, right? If you're part of a syndication or something, or get out there and try to figure out how to be a hard money lender yourself, for example. And we picked real estate because it's tangible and everybody can really relate to it. In fact, 2/3 of us at any given time are homeowners in the United States as it is. So we found our way to real estate. We found our way to residential real estate. And in the end, we created a product that fills an important gap in most people's portfolios, which is, real estate debt, right? It's very low volatility, very short term, very high yield. And it's a really nice counterpoint to a lot of the high volatility, higher risk securities that are out there available for investors today.
So when we first spoke, one of the things that you and I talked about is how GROUNDFLOOR is changing this availability for the everyday investor and the accredited investor. What was the reasoning behind that? Why did that cause you, as you mentioned, so much grief when you first told your seed investors that you were going to head this direction?
Yeah, I think there were a lot of companies that sound like GROUNDFLOOR kind of started at the same time, right? They all talk about democratizing investing. They all talk about crowdfunding real estate, for example. There are a lot of companies that sound the same. We were the only one that had the strategic intent to create a financial product for everybody. And so we went through the SEC's qualification process in order to make that possible, to invest in this format. But the reason we did it strategically is we think that capital markets that are broader based, that have many more nodes in the network, if you will, are more resilient through ups and downs, are more reliable, which is very important if you're going to be lending, for example, or providing capital to entrepreneurs. We think a capital market that's structured the way that we've done it is more durable. And we definitely saw that during COVID-19. So, those of you who invest in non-traded REITs probably got an ugly letter, from your REIT, and you may still be subject to these types of restrictions. They just all decided to shut down distributions when COVID came. Institutional investors just stopped buying credit, and credit markets froze up. That didn't happen for us. For us, our network of thousands of individual investors actually doubled down and started investing more. We did records for investment volume in Q2 and Q3 coming out of COVID. And that's because we built this really broad capital network and we give people control. So, if you wanted to withdraw your money as your loans repaid, you could take your money out. If you wanted to take money out of the public markets and put it to work in GROUNDFLOOR, we had plenty of supply. And so we've just built a very unique capital market. And that's the reason we did it, because we wanted to make sure we built a capital, a foundation of capital that, could survive through thick and thin and give people control over their money. I think it's a travesty the way that, fund managers have all these rights to kind of hang on to your money precisely when you need it. And with something like GROUNDFLOOR, and there are other platforms that have done similar things, like in small business, there's Honeycomb. In sort of impact investing, there's Small Change, for example. We all have built, there are a few of us now who've built these platforms that allow you to invest, diversify through a low minimum and and get access to this very low volatility, attractive sort of asset class.
So you not only use this process, this methodology to give exposure to these loans, but you are actually somebody who's eating your own cooking, and you have been very successful at raising money for the operating business of Ground Floor. Can you tell us a little bit about that? Can you go into a little bit of detail about that
We're a
experience?
high growth technology startup, right? We were ranked within the top 10% of the Inc. 5000 fastest growing small companies or privately held companies in the United States last year. That was a really nice accolade. Deloitte named us the 102nd fastest growing technology company in the country. So we're a high growth startup, and high growth startups, as many of you who've invested in them know, or you've read in the media, right, often willfully incur losses, are unprofitable for a while in order to maximize their growth rate and really maximize the opportunity. I mean, we have a huge competitive lead in what we do, a very unique position. So we raise capital in order to grow instead of only growing through our profits. When we went to raise our capital in the early days, when we were just getting started, we used angel investors, and we raised a VC round from FinTech Ventures, which is a fund based in Atlanta, of $5 million way back in 2015. That's right after we got qualified. But since then, as we grew our investor network, we realized that to be true to our mission, we really needed to open up ownership to everybody. I mean, why, if our mission is to open up these public markets, why would we turn to just private equity and venture capital, those kind of rarefied airs of the capital markets? Why would we do that when we have a base of investors and could give them access to own a part of the company? And so we've been raising capital this way for the last 3 years. We have about 5,000 investors now who own collectively about 27% of the company. And what's up on the screen here is our page on Seed Invest, which is a portal that a lot of startups use. There are several of these out there to raise capital from individual investors to sort of crowdfund the equity of their company, if you will. And it looks like we're kind of scrolling through our page right now. You can go on here and buy, I think the minimum investment's about $1,000. The share price is there. There's a lot of detail about the company. There's a pitch deck that you can leaf through. But really the purpose was to raise capital in a way that was aligned with the mission of the company. And it's just been fantastically successful for us over the last 3 years.
That's great. Very impressive.
Up to $4 million. I think in aggregate, we raised something like $27 million since inception. So we've become pretty adept at financing the growth of the company this way.
So we keep bringing up this word democratization. It's a term that's been thrown around a lot these days, especially during the onset of the pandemic. We saw many platforms who cried democratization that effectively disallowed investors to even access their own money. And then we saw what happened recently with Robinhood. Brian, can you speak about how GroundFloor is allowing everyone to invest and build wealth through real estate in a lower risk, and I stress lower risk, and more reliable way?
Yeah, I mean, the first thing that you'll notice is the same people who are, talking about democratizing these markets and providing access to them, when the going got tough, they disappeared. They headed for the hills. They shut off access, like the non-traded REITs, for example, even the fancy new ones who proclaim themselves to be revolutionary, democratizing this area. You come to find, when you look under the covers, they have all kinds of fine print about how they can control your access to your money. Well, that tends to, if you talk to any psychotherapist, they'll tell you that anger is just when you're blocked from doing something. People got very angry, and just like happened to Robinhood, people picked up their pitchforks, because when you're Robinhood and you sound like you're this big disruptor, and it turns out that the truth is that underneath the covers, you're really just using the same financial infrastructure and the same rules that all of the other incumbents are. You're really no different, from E-Trade and Fidelity and all of the other incumbents who are there. And that people feel a lot of resentment about that, right? When they feel blocked by somebody who's supposedly democratizing a market, you have to ask yourself, you know, is there any alternative where I truly do get control, where I can play a game that isn't actually rigged? And that's what private markets can be, right? Private markets done right are good for non-accredited investors because, you know, like people like us, we've gone through the process of qualifying our offering with the SEC so that people can rely on disclosures and, you know, we have regulatory oversight. But that's also good for accredited investors who invest in this space because you don't have to invest based on just what the PPM says. You get to invest based on audited financials. You get to invest on the SEC's regulatory oversight and very standardized, highly standardized disclosures. So, you know, when I think about the term democratization, you know, democracy requires participation. If you're not truly giving people tools to participate and control what they're doing, is how democratic really is it, right? If you can't vote, how meaningful, you know, if you can't vote with your feet or your dollars, how meaningful is the democracy that you're talking about? That's sort of what happened over the last year left me wondering.
So can you talk about, you know, risk reward and why the underlying strategy of Ground Floor is actually, you know, it's a better option from an investment perspective,
right,
than the
well,
alternatives?
Look, we created a debt product, right? We could have created an equity product. We could have created a debt product. We could have created an equity product that's not, or debt product that's not backed by anything. As it happens, we realized that if individual investors were going to be entrusting their money to us, we wanted to make a product that had all of the advantages that, you know, Wall Street and the banks always have when they lend. So we actually go in and we put a lien underneath every loan we do. And so even if the borrower runs into trouble, can't complete the project, right, and we have to foreclose on it, we always have that asset value to fall back on. And that's why our loss ratios are so low. Our loss ratios are well under 1%. And the 10.6% return that we, you know, 10.5% roughly over the years that we're delivering is net of that figure. So you're really getting a lot of security. And if you invest in a lot of properties, right, a lot of loans, you get a lot of predictability. And we actually published a diversification analysis that shows how every portfolio on our platform has performed. It actually plots it on a graph by the number of, you know, loans that they invested in and their returns on average. And what you see is that those dots really cluster around 10% as long as you've invested in 50 or 100 loans. So the strategy is to give people access to something that you really wouldn't have access to, certainly not $10 at a time. The alternatives for getting access to it would be pretty limited and pretty risky by comparison.
So we have some questions in the Q&A function. One of them actually is talking about returns, numbers.
Sure. Yeah.
How did you guys fare during the pandemic? What did 2020 look like?
So we were at the beginning of the pandemic, we did a stress test of our portfolio that we published on our blog, and we published a lot of stats and figures on our blog. So I'll refer to that a lot. If you go there, we actually asked, what if 2008 happened to our entire portfolio, right? And in 2008, you know, in many markets, asset values declined by 30%. So we stress tested the portfolio bottoms up, I think about 600 loans, you know, 600 loans in our portfolio. We said, what if they all went down by 30%? And in the course of going down, what if, you know, a number of them went into foreclosure and we had to pay the expenses of foreclosure? What you find is a return that still is not negative and is still, you know, it's certainly not the 10.5% return that we ended up delivering through COVID and that we've maintained. But we realized even in that worst case scenario, those returns might be cut roughly in half. And the time to get your money back, to cycle your money, might not be as fast as 9 or 10 months, but it might on average be 14 or 15 months, which is still pretty darn fast. As it happened, our loss ratios really didn't increase much. Our net returns stayed right at 10.5%. And we actually published every week, starting at the beginning of COVID, a blog post showing exactly what happened in our portfolio with individual properties, showing the sales price versus the predicted sales price, the return versus the predicted return. And what you see is very strong performance through the entire cycle with COVID. The one kink in our armor was just a little bit of a delay in recovering. some of the loans. We had more go into default. We had more go into maturity default or sort of to be late. But that's to be expected given what's going on in the world. So the portfolio held up remarkably well.
So there's a lot of questions in here, and I'm going to try to lump a couple of them together also with some of the comments. There's some people that are chiming in and that saying that they've invested with you for over 2 years, that you have a great team and offer great exposure, in key growth markets like the Southeast. So congratulations on that. We handled the returns. Last year was not an easy year, so more accolades to you and to the team. There's a gentleman that's asking about IRA. Like how do you handle if they want to put money in from an IRA? And before you answer that, I also want to lump in a question, because we're getting close on time, about how do you invest in the operating business? And if you can separate those two issues out, I would appreciate it.
So, sorry, the first question was what? About?
The first question is about IRA money and how they can invest.
So we have a way, we have a white label ground floor IRA that's provided by one of the leaders in this space, IRA Services Trust, now known as Strata. So that's one option, and you can roll your IRA funds into that. If you want to use your IRA, if it's a self-directed IRA where you have check writing authority, we can set you up as an entity account on the platform in order to invest out of that LLC. So if you don't have check writing and you ability or authority, and you just have a standard self-directed IRA that doesn't have that, you just have to check with your custodian to see if they'll allow you to invest in this. They'll consider it a private offering. So you just have to check with them on that. But if they don't, we always have a solution for you too. At Ground Floor, we have hundreds of people who utilize that, because your IRA is a great way to invest in this type of thing.
And then the second part of that question is about, the seed invest and the offering into the underlying business. How can people find it? Like, how is it that they should think about that type of an investment?
So that's an investment in a startup, right? Investing in startups is much longer term, much more volatile. It would be at the opposite end of the spectrum, the risk reward spectrum, from what we do with our loans, right? So think of it that way. Think of, startup investing is, very risky, right? I like to think that our startup is not as risky as many startups. We're certainly later stage because we have last year $6 million in revenue. We have 50 employees. We have, customers. We have a business that's 8 years old. But if you want to look at it, you should go to seedinvest.com/groundfloor. You can check out everything about the operating company there. And they make it pretty easy to invest once you set up an account. And I don't know if they allow IRAs there, but if you want to invest through your IRA, you can do that with us. That's a way to do it.
Brian, I appreciate you being involved today. I appreciate you doing this fireside chat. And I actually wish that we had more time to go into the questions that you have and the questions that I have. But I will forward the information over to you so that you can follow up with
Absolutely. I'd be happy to.
And
we also answer questions on that Seed Invest page about the company too. So if you like to, we have a Facebook group where you can ask questions about the investments, and there's a lot of opportunity to interact with us.
Thank you very much. And
thanks, Michael.
Thank you to Ground Floor for being a sponsor of today's event and being involved. We really appreciate your support.
You bet. Happy to do it.
All right. Thank you.